Perfect. A little bit about me. My name is Susan Lopez. I'm with Social Insurance Agency. I have actually been in insurance, like I said, for 15 years. For 14 of those years, I was with American Family and did everything from A to Z. So I do know a lot of about the vendor insurance that you guys are asking for, because I wrote a lot of policies for a lot of vendors. And I've been teaching on master communities and doing master insurance for a long time. And I really enjoy the teaching part of it. But let's get to insurance, which is everybody, like I said, their favorite, not favorite topic. I'm going to go really fast. I'm going to give some generalizations, and I'm going to kind of echo on some of where we're at in insurance. In the insurance industry, before I start my slide, it is a hard market, just like Connor was saying. It is a bank. Imagine the insurance industry as one big, huge bank that is literally has ties throughout the entire world. So when something happens in Florida, when something happens, war breaks out in Ukraine, you know, something happens in Haiti, or all of these risks and all these perils that happen throughout the world, it's like one big bank that all pays all these claims out and all these amounts out wherever it is. And that's through reinsurance and bigger insurance companies backing smaller insurance companies. So yes, in the past, 5 years, insurance has gotten crazy. Last year, in the middle of the year, we were feeling like maybe we could breathe a little sigh of relief, and maybe there would be light at the end of the tunnel in like 3 to 4 years, and then California just happened. So, insurance premiums, I'm just going to talk to you straight. They're not going away. The problems are not going away. The eligibility requirements are getting higher and harder. And just like Connor said, there's a lot of carriers that don't want problem communities. That means older claims, not fully funded, reserve studies, deferred maintenance. They'll just turn their back and say no and put you into a non-admitted market. So to that point, let's talk a little bit about what insurance is, and then I'll tell you what we can do to kind of help you guys stay on the path of the least amount of hurt as opposed to the most amount of hurt. I talked to Jeff, and I know most of the board members, I think, are single family communities, not so many condos, but insurance only has two definitions: condominiums, and they're very different from architectural or the way they're deeded on the county assessor site, whether they're townhomes or patio homes or duplexes or fourplexes. Just as general knowledge for insurance, there's two types of policies: a condo policy, master policy, and a single family master policy. Condo just means that there is something in the CC&Rs that dictate the association is responsible for the livable buildings. That's all it means. It could be 8 units in a building, it could be 1 unit in a building. It just means that the CC&Rs dictate that there is a policy that has to replace or that's responsible for part of the building, whether it's the walls in or the walls out. That's something for another day. Single family home associations or PUDs, that's where I think most of you guys live in, and those where you own your own home, and the master association and the master policy is there to just cover your common area elements. For a small community, it might literally just mean lights on your streets if you're responsible for that, maybe a monument out front. You might have a cluster of mailboxes. For the larger communities, it might be a pool, a clubhouse, parks, barbecues, benches, private streets, the gate. I mean, it goes from, one end of the spectrum to the other, depending how much community property you have. So for property coverage, those are the two types of master policies for insurance that you have, either condo or single family. And obviously the property is, like we said, the structures, applying to the structures. And that could even mean, like I said, the streets or, whatever the common area structures are, playgrounds, whatever, gazebos. One of the things when you're talking about property coverage that you guys want to be aware of is you want to make sure that you have everything accurately insured. You don't want to be underinsured, because you could be penalized for insurance, where you would be responsible for the difference in the value of your property. The easiest one would be for me to use as an example is a clubhouse. Let's say the clubhouse was insured, an agent went in and insured the replacement valuation as, I don't know, like $500,000, just because it's easy. But when the claim happened, there's a fire that happened there, and the valuation came in at like $600,000 or $650,000. Depending on what kind of policy you have, if you're below a threshold, then the community is going to have to come out of reserves and pay for the difference in in the building. So you may only have, $550,000 of coverage. You're going to be responsible for another 100,000 out of your own reserves. So whenever you're insuring property, whether it's condo or common area properties, common area elements in your single family homeowners association, you want to make sure that the valuations are not only current, correct, and of correct value. You also want to make sure that they're reviewed at least every other year. If there's something crazy like COVID is one of those, anomalies, you're definitely going to want to see that you change it because you knew labor and materials went up like crazy those couple of years. So you just need to look at that and make sure that your replacement costs and your building valuations are correct for all of them. Your playgrounds, your monument signs, your fencing, or the block walls that you have that the HOAs sometimes are responsible for on the exterior of the community. Those things you just want to make sure you guys have the correct valuation and the correct coverage. The lender, whether loans not funded, if they're underinsured, that's mostly for condos, you guys. I can't imagine, and I'm trying to think of any practical application in a single family house that was for sale or had loans. That doesn't really, even if the clubhouse is underinsured, it's not really part of the situation there. But that's mostly for condos. If you're underinsured, you're not going to get a conventional loan. When you're looking at insurance, you guys want to make sure you have, the biggest thing here for single family is your AM Best rating. This tells you the strength of the carrier. So Philadelphia, for example, is an A++ rating. Why should rating matter to you guys? If somebody were to fall in rating, there's like A++, A+, A minus, it keeps going there into B. First of all, the lower the strength of the rating, that just means that that company, let's say it, I don't know, let's just use Philadelphia just because I just said them. If Philadelphia's rating slips, it just means that if a large claim happens, the rating says that they don't have enough money in the bank to pay for multiple large claims in 1 year. So if you have a carrier that does not have a good rating, then you can write them, but chances are, if they're not a good carrier and strong with their finances, and you have a claim, like a year later, it's not promised that you're going to have that money, that they're going to have that money to turn around and pay you that claim, whatever the claim may be. So you definitely, for the HOAs and single family associations, you guys, ask your agents for the AM Best rating. And all of the agents that you guys work for should know that and should have access to that, because I look it up all the time, and I make sure I have a little Excel spreadsheet that lists what rating each carrier is when I make proposals. So definitely look at that. The other thing is just when you're talking to insurance, nobody likes going through claims. So just ask them about what the claims process is. You want to make sure that they're responsive, that they're timely, and that the claim can be closed timely and they know what they're talking about, because claims experience is terrible for everybody, and we need to just get through it, remedy the situation, and get you back to where you were. So just things to think about for insurance. Connor talked about this for a little bit. This is the protection that I don't know that anybody would step up and volunteer to make decisions for a community. So the boards, if they did not have this, would completely open themselves up to potential liability. The boards are making a best business decision, right, on behalf of the community. And some of the claims that come in on D&O, it could write a book. Some of them are kind of funny, and not funny that the claims come in, but I can't believe what some people actually put forward on a claim for D&O. But this protects the directors and the officers, so they can freely make the decision in the best business practice for the best of the community. So it pays for defense, it pays for settlements. If there was a settlement and a lawsuit, it covers wrongful acts of any directors and any of the board members. So it gives complete protection for the board members to just act like a board and make decisions that need to happen for a community to continue. And this is just some of it. Duty to defend in lawsuits for non-monetary claims, breach of fiduciary duties. All of these will be protected and defended, and the legal fees will be paid for out of the D&O, the directors and officers policies. including this, here it is, discrimination and inadequate insurance. So D&O is definitely an important policy that you want to make sure you keep active for every one of the communities. What you should look for in any insurance carrier or agent that's representing you. For risk control, anybody who's going to be writing your policies, they should be visiting the property. They should have boots on the ground to look and see if there's any kind of risk out there, exposure. Are there lifts in sidewalks? That could be a slip and fall hazard, which we wouldn't want, because that's what's terrible. That would hit your general liability, for bodily injury. You wouldn't want that. Anything that looks deferred maintenance, that could be, if there's, let me think, if there's carports maybe, I don't know, or covered parking in maybe a park area, slides, parks that, playgrounds that may not be in the best shape. We wouldn't want any kids getting injured on that. But anyway, somebody should walk the property and talk about what areas they see that are potential hazards and potential risks that the community may want to address. Definitely make sure they know what they're talking about. HOAs are a little bit easier, or the single family, but I've been doing this for, like I said, 15 years, and 80% of the agents out there, I think, when it comes to condo policies, they don't know how to write the master policy, and there's a lot of them that don't know how to write the unit owner's policy. I've seen it over and over and over again. Of the 20% that are out there that do know how to write it, I think like 5% of us know how to explain it in layman's terms. So make sure you're comfortable and that you're understanding your insurance, and that your agent or whoever your representative is well versed in the insurance industry and it can explain it to you in a good way. And then education. Go to board. They should be going to board meetings, talking to managers, do any kind of training, unit owners letters, in person. Give me a call. I get calls from my unit owners multiple times to help them either with a claim or understand coverage and how they should be covered on their personal lines. So just make sure that you've got somebody representing you that knows what they're talking about. I already talked about rerunning your property. I'm just trying to go through this so I'm not taking too long. And before I go into a little more general on a few other things, there are other things you want to avoid from an insurance agent. So renewals come out 30 to 45 days before your effective date. So if somebody's holding on to your renewals, or an agent or something like that, up until the last day, that's not a best practice. That pretty much pigeonholes the board to finding out whatever they're going to do and give time to vote and figure out the premiums and how they're going to pay for it. So make sure you're getting renewals ahead of time. Make sure you're getting documents that you request, certificates or evidence of insurance in a timely manner. And then make sure they're discussing options with you, deductible changes, endorsement differences that maybe they're on different policies. And that's pretty much what you want to look for insurance. I'm going to escape out of here because this is the end of my PowerPoint, and I want to talk to you guys about where the insurance industry is and what you guys don't want to go into. So like Connor said, prices are crazy, but there are two kinds of markets in insurance. There's called the admitted market and the non-admitted market. Admitted carriers and rates have to literally file their rates every single year with the State Department of Insurance. So the Department of Insurance, the Arizona Department of Insurance, and they have to approve those rates. So if they're going to say, I'm going to charge 19 cents per thousand or whatever it is in XYZ risk, the Department of Insurance has to approve that. If they don't approve it, that carrier does not get to write in the state of Arizona. So non-admitted markets don't have to file any rates in the state of Arizona. And the non-admitted markets are the ones that are going to charge a lot of money because they're the ones that are going to take on the higher risk. The ones that have the communities that are older, that maybe have one huge claim or several small claims, they're the ones that the admitted carriers don't want to write. Maybe older communities, they have, older communities that have a clubhouse that have our wonderful aluminum wiring or fuses or ineligible electric panels. Let me tell you, this is a really hard thing to do. But what I want to tell you guys is that if you go to the non-admitted market, a community that might have been paying $20,000 in insurance premiums a year can very easily, and I'm not doing this to scare you because I'm actually doing this right now with a multitude of my clients, very easily could go from $20,000 to $100,000 a year. And it could be for 5 years. So what can you guys do to not go there? Higher deductibles is fantastic for anybody who has any large amount of property. You know, playgrounds, benches, a wall, a perimeter wall that goes up to a major street. Jeff is going to know this. I mean, where a car will wreck right into that wall and take off. A car will wreck into a gate and take off. If they stay, it's great. They'll give you their insurance, and their car insurance will pay for the repairs. But in my world, it feels like most often they hit the wall and take off, and it's like 2 o'clock in the morning. So higher deductibles, I know it comes out of your reserves a little bit more, but it stops the claim from being on your losses, and your losses are there for 5 years. So make sure you guys are proactive. You know, have your reserves fully funded. Make sure deferred maintenance isn't there. Have a plan. I know HOA fees and dues are the scary subject of board meetings and managers, but like this is where I feel like I'm giving my mom and dad talk. You guys have to be proactive to make sure your communities are well maintained, so that there's little risk that can happen in any kind of claim. Because the last thing you guys want, and I hate this about insurance, that's why I didn't want to get into it 15 years ago, is you pay into it, you file a claim, and your rates go skyrocketing. Well, now it's not just that your rates go skyrocketing. It's like vendors, I mean, carriers will not want to write you in an admitted market. And I don't like that part because it's very scary. And some of my communities may be pricing many of their unit owners right out of owning their own homes or their own condos because they can't afford the difference in insurance and the HOA fees or assessment that has to happen. I don't think that's fair, but that's what's happening. So as community owners and unit owners and board members, be active in your community. If you see that a sidewalk is lifting a little bit, talk to your manager about it and say, hey, I don't want somebody to trip. And yes, maybe 90% of us out there would trip, knock our knee, go home and not do anything about it, which is fantastic. But there's a 10% of us, not us, there's 10% of unit owners that will sue, you know, because of bodily injury. And that just opens you guys up for exposure on another claim. So the more you guys can maintain your communities and everybody be active on looking for any potential risks that can happen, then it takes a village. That will keep you guys in better rates so that the insurance doesn't hurt you as much as it could. Because I'm not here to tell you that it's not going to hurt. Insurance is not going anywhere for at least another 5 years. It's going to be hard, and they're going to get more strict on the eligibility requirements. So just take care of your communities, guys, and be proactive. And if you guys have any questions, Jeff has my contact information, and I'm more than willing to, you know, take this on a different deal. But yeah, I just wanted to make sure you guys all know where insurance is and just stay involved and be proactive. That's the best thing I can say for you guys.
And just want to say thank you, board members, for taking the time out of your evening to learn about risk avoidance and how that can benefit you and your community. And a special thank you to both Connor and Susan, and to both Vive and the Social Insurance Agency for letting us have you join us tonight and give these presentations. So thank you so much. And with that, we'll say good night.
Thanks, everyone.
Good night, guys.